Hey everyone, as many of us know, the bank delivered a jumbo rate cut yesterday of 0.5%. This means that for every variable rate holder, their rate will come down by 0.5%. And for some of you, it will affect your payments by about $15 per 100,000 of your mortgage. Some of you that have a VRM, it won't affect your payments, but your amortization will begin to settle. So where do we go from here? What's going to happen? Why did they hit this big rate cut? So the big surprise right now is inflation dropped unexpectedly down to 1.6% last month. It was supposed to come in at about 2%. That was a big one, a big eye opener for the Bank of Canada. So now that we are sitting with lower inflation and we're ahead of the game, is now they've got to stimulate the economy. They've got to stimulate the economy because there's less money to spend out there. So now they want to drop rates and give some cash flow back to us so we get back out there spending more money. So what can we expect in the future? Now, the forecast is looking like we are going to see another few rate cuts here over the next 6 to 8 months, depending on how or when we get them. The implied forecast is to see another 1 to 1.5% in lower rates from now until the end of 2025. As for the banks, they have adjusted their numbers as well. Is up here, the implied rate path is maybe 1 to 1.25. Some of the banks are saying we're going to see up to 1.5, maybe even 1.75% more in rate cuts. So we'll keep an eye on that for you and let you know as that progresses. It really all depends on how these numbers look. Now, the 3-year bond yields. If you had talked to me back in May of this year, before the rate cuts started to happen, we would have a 3-year fixed rate back here at 5.35%. When we take that all the way down to today's dates, we're getting 3-year fixed back at about 4.29 to 39%. This should trend lower depending on what is happening within the markets, but expect some of the fixed rates to come down as well. Now, the unemployment numbers, they came down a little bit last month, but expect these to continue to rise as expected by many economists, for it to pop up even as high as 7%. Now, what would I do in today's market? So when we compare the two here, let's have a look. Now, the 4 and 5-year fixed rates, they're too long to commit to. What I don't want to do with my clients is have them take a 5-year fixed or a 4-year, and then all of a sudden in a year from now, the rates are 1 to 2% lower, and they want those rates, but they're now going to have a huge penalty. Now, if I look at a 1 and 2-year fixed rate right now, those are short-term rates, but they're roughly about the same as the variable, and we know the prime rate's going to come down. So the trend today is looking at a 3-year fixed, which is around that 4.29 to 4.39, and a variable, which is about prime less 0.8 to 0.9. When we look at this based on a $500,000 mortgage over 25 years, we can see that we're down about $10,000 in interest over 3 years with the rate comparison of 5.1 to 4.39. However, if we factor in the prime rate decreases that we're anticipating, which is more cuts coming in the next few months, so dropping it down 1.25 by October of next year, if we apply those, now we're actually saving money. So the suggestion right now is to keep riding the prime rate down and then lock in later if that's something you want to do. But essentially, we will likely see the variable rate mortgages be lower than the fixed again, which is very typical historically. So that's an update for you. If you have any questions, if you need anything, you need any planning help whatsoever, please let me know. And I look forward to seeing you at the next date, which will be in December, and wish for either a quarter or half point again. Have a great evening, and we'll chat with you again soon. Bye for now.